Welcome, my name is Blaine Carr and I'm a Senior Wealth Advisor with Petersen, Hastings. We are an independent wealth management firm located in southeastern Washington, and we are passionate about fiduciary-centered advice and also about educating our clients, our prospective clients, and the community at large. Today is my first video webcast, and I plan to do more of these in the future. The topic that I'm going to talk about today is 2020 required minimum distribution rules. As you might be aware, account owners are required to start pulling money out of their accounts such as IRAs, beneficiary IRAs, and most employer-sponsored retirement plans upon reaching age 72. This used to be age 70 and a half, but with the passage of the Secure Act in late 2019, they increased that age to age 72. This required minimum distribution rule requires the account holder to take a minimum amount out of their account by the end of each calendar year. Now, there are a lot of rules related to required minimum distributions, but today I'm going to focus on one that is particular to 2020. 2020 has turned out to be anything but a normal year. When the stock market crashed earlier this year, Congress passed the CARES Act, and that provided relief from having to take required minimum distributions out of accounts. This is intended so that investors do not have to sell at low values just to take the distribution. Now, for those of you who do not depend on your required minimum to fund your living expenses, this rule has provided an opportunity for some tax planning. Now, at this point, I do not expect the similar waiver to apply to the year 2021. So, what should you do if you have not taken your required minimum distribution yet? My favorite answer is, it depends. So first, if you need money to live on from your required minimum distribution, then you don't have much of a choice unless you can afford to reduce that distribution a little bit. Second, if you anticipate the expenses for next year to be a little higher than what your required minimum distribution is for 2021, it might benefit you to take a little bit of that distribution out this year just so you don't have as much income coming out of your IRA next year. After that, it gets a little more complicated. You might save more tax than you realize if you skip or reduce the distribution you take this year. For those of you who are in the 12% or lower tax brackets, your dividends and capital gains might be taxed less if you take a lower distribution. Also, your Social Security benefits might be taxed less if you take less out of your IRA. So if you were in a higher income tax bracket, it might benefit you to eliminate or reduce your distribution in order to prevent going into the next IRMA bracket. Why does that matter? If you go over the first Medicare limit, your premiums will increase about $70 per month starting in 2022, and those premiums would increase even more the higher brackets you move into. I will cover more of that in a future video, but if you want to see more information about that in the meantime, you can go to medicare.gov. If those situations do not apply to you, you might be better off taking your distribution as planned and reinvesting it in an after-tax account or padding your savings account with it. You might also consider a Roth conversion. A Roth conversion is taxable, but a Roth account will not only grow tax-free, the distributions coming out of there will also be tax-free if you leave them in the account at least 5 years before withdrawing them. And finally, you might be using your IRA to fund charitable contributions. One of the best ways to do this is to use the qualified charitable distribution. With this method of giving, you don't get the normal deduction as an itemized deduction for your gift. Rather, if you follow certain rules, including instructing your IRA custodian to send the check directly from your IRA to the qualified charity, that distribution is not taxable. So many account owners will benefit from continuing to make those distributions. But you may also want to look at whether you will give all of your required minimum distribution away next year. If not, you might want to save a little bit of that and use it as a QCD for 2021. Okay, let's sum this all up. Some of you might benefit a lot by taking a pass on your required minimum distribution for 2020. Others of you might be better off taking that distribution or doing a Roth conversion. And finally, for those of you who are taking qualified charitable distributions, you can continue to do those, but you also might want to consider pushing some of that out to next year so that you reduce the tax impact of 2021's required minimum distribution. As always, you should check with an experienced tax preparer or investment advisor prior to taking any action on this. I hope you enjoyed this video today. And if you did, I appeal to you to hit that like button and share it with your family and friends. Have a wonderful day.